rise of environmental, social, and governance (ESG) investing has captured headlines, swept boardrooms, and filled the vernacular of modern financial discussion. According to estimates by Bloomberg, ESG assets are projected to exceed $53 trillion by 2025, making up a third of global assets under management. However, before we canonize ESG as the future of investing, it's imperative to examine whether it's a paradigm shift or a fad. Legendary economist Milton Friedman once famously said, "There is one and only one social responsibility of business: to use its resources and engage in activities designed to increase its profits." The core objective of investing is to maximize returns, and ESG does not necessarily align with this. While some studies suggest that ESG funds perform comparably with traditional funds, a 2019 report from the Pacific Research Institute argued that ESG funds underperformed the S&P 500 index, costing investors as much as $4.01 trillion over 2 decades. Therefore, when economic tides turn rough and investors face the risk of diminished returns, the altruistic motives behind ESG may quickly fall by the wayside. Measuring ESG is not straightforward. These metrics are often subjective and open to interpretation. Furthermore, the lack of standardization in ESG reporting creates inconsistencies that cloud investment decision-making. Warren Buffett once noted, "Risk comes from not knowing what you're doing." In the muddy waters of ESG data, it's challenging for investors to understand what they are getting into clearly. There is an increasing risk of greenwashing, where companies project a false image of environmental responsibility. Even the European Securities and Markets Authority, ESMA, has cautioned about the risks of greenwashing as the ESG market grows. When you combine greenwashing with the recent surge in token gestures like appointing a single female board member to check the test in ESG, it becomes apparent that some of these efforts may be more superficial than transformative. The Biden administration has actively supported ESG initiatives, but the political landscape is transient. Regulatory frameworks guiding ESG investing are still evolving, and political shifts could lead to significant reversals. The lack of long-term regulatory certainty undermines the durability of ESG as an investment strategy. History teaches us that investment trends often follow a cyclical pattern, marked by a boom and inevitable bust. At their time, the dot-com bubble and the real estate boom were considered the future of investing. Yet these trends failed to sustain themselves over the long term. While ESG's underlying ethos is commendable, it's worth considering whether it will follow this cyclical pattern. While ESG's aspirations are noble, its efficacy as a long-term investment strategy is still debatable. At worst, it could be a well-intentioned fad that fizzles out with the next economic downturn or shifts in political winds. Investors must tread cautiously and consider whether ESG investing offers genuine value or is merely the financial world's flavor of the month.